Now, understanding options is going to be a cakewalk for you. It is going to be the easiest one for you. Throughout your life, you may have had situation where you have tried your best to understand options, call and put, but at a certain point of your learning in the phase of options, you would have kind of broken down, which means you understood what is a call, you understood what is a put, you understood what is buying a call, selling a call, buying a put. But by the time you reach to the point where you're trying to learn what is selling a put, maybe the fuse of your brain would have started kind of diffusing. So today, take it as an opportunity. I'm giving you a head start with the option world. But today, in the option world, I'm just going to give you a head start of what it is. Okay? And it will not take much time for you to grab it. I'm sure about that. The way I've taught you the entire derivative world, it is very easy. It's going to be very easy for you. Fine? Now, suppose if I have an expectation that a stock, which means let's say Reliance only, the same example. I have an expectation that the price of Reliance Industry in the next 1 month is going to go up. It is right now 2,500 in the spot market. Okay? And I have an expectation that it is going to go up. The price has to go up. Okay? So I have an option. What I can do is I can go and buy the future of that stock. It's called FUT-STK. If it is an index, it is called FUT-IDX, for example, in Nifty. So I can go and let's say long one lot, right? Long one lot Reliance. Okay. All right. And for simplicity, I'm assuming that one lot is 300 shares. So it is approximately 7.5 lakh ka contract size. Okay. Now the future price will have a slightly higher price than the spot. So let's say the future price is 2,505 right now. Okay. The bid offer is there. This is the LTP, last traded price. So I can go and long. Now let's say that we are going to hold it till expiry, and the expiry is 20 days later. Okay. Now on the day of expiry, two things can happen. Either the price is going to be above my future price. This is, by the way, my cost price, because this is my predetermined price. I have to abide by it. Now a future is a promise which you cannot break. Okay. All right. And you have already given the initial margin, and you are giving the MTM also on a daily basis till now. Now, suppose if I want to calculate your net profit and loss, and for that I'm waiting for the expiry, and right now assume that the expiry is price settled and not delivery settled, let's say. Then any of these two can happen as an example. Either the stock can expire at, let's say, below your future price, or it can expire above your future price, correct? Now, to make the calculations even more simple, I am going to do a small little tweak here. I'm going to think of it like this, that right now, the spot price is 2,495, okay? 2,495, and the future of the current month is 2,560. Is that okay? And now the expiry is happening like this. Any of these, obviously both cannot happen, so it's either or. Now let's try and understand in which one will you make money and which one will you lose money. Now, since you have longed the future, you have committed, and it's a commitment, it's a promise, you have committed to buy the stock at 2,500 on that expiry day. Okay, that's what it is. Just that you have taken out some time. You wanted to buy it 1 month ago only, 20 days ago only, but you waited for 20 days. Maybe you were arranging for cash or something, because the value of it is 7.5 lakhs, and you had given an initial margin of, let's say, 20%, which is 1.5 lakhs. Remaining money now you may have arranged. However, this example is taken based on price settlement. Okay. Now, assuming that if the exchange would have thought of making a delivery settlement, then what you would have done is you would have to buy it at 2,500, even if, let's talk about situation number one, even if the price is 2,400 on expiry. If the expiry day price is 2,400, you could have bought the stock directly at 2,400. But the exchange will tell you, no, you have to buy it at 2,500. You have done a promise, you are committed, you have to buy it at 2,400, at 2,500, even if the actual price in the market is 2,400. So the exchange will imagine it like this, that you will be buying this stock from the other party at 2,500, whoever is on the other side of the contract, who has shorted basically while you went long. and immediately sell it in the market at 2400, thereby have a loss of 100 rupees.